Overview of mortgage financing. Chapter 17 brings together everything a salesperson needs to understand about how real estate is funded, how loans are created, how borrowers qualify, how closings occur, and how the larger mortgage market supports the entire system. Earlier chapters taught you value, appraisal, and market behavior. This chapter shifts the focus from what is the property worth to how does a buyer actually pay for that property. Financing is woven into almost every transaction you will ever handle. Buyers rarely pay cash. They borrow funds, pledge the property as collateral, and depend on mortgage lenders who operate under complex rules, guidelines, ratios, and consumer protection laws. The anatomy of mortgage lending. The financing process begins with two foundational legal documents: the promissory note, which is the borrower's personal promise to repay, and the security instrument, either a mortgage or a deed of trust, which pledges the property as collateral through hypothecation. The chapter explains the difference between lien theory and title theory states, and why foreclosure procedures vary based on which instrument is used. You learned how principal, interest, points, loan terms, and amortization form the financial structure of every mortgage. Examples showed how early payments consist mostly of interest, how extra principal payments reduce long-term cost, and how borrowers may pay points to lower interest rates or allow lenders to meet desired yields. Initiating the mortgage loan. A loan begins with a formal application. The Uniform Residential Loan Application collects detailed information about the borrower's income, assets, debts, employment, and property being financed. Once submitted, the file enters underwriting, where the lender evaluates the borrower's ability and willingness to repay and analyzes the property's collateral strength. You learned how income stability, debt-to-income ratios, credit scores, net worth, and cash reserves shape approval. The property itself is evaluated through the appraisal, and the resulting loan-to-value ratio determines down payment requirements. High LTV loans often require mortgage insurance, shifting part of the lender's risk to an insurer. Understanding payment structure. A mortgage payment often includes PITI, principal, interest, property taxes, and homeowner's insurance. If the down payment is small, mortgage insurance may also be added. This chapter helped you explain to clients why their monthly payments include escrowed taxes and insurance, why interest is paid in arrears, and why payments feel slow to reduce principal early in the loan, but accelerate in later years. This foundation allows you to answer common buyer questions about affordability and long-term budgeting. Regulatory framework protecting borrowers. You explored the legal environment surrounding mortgage lending. Truth in Lending, TILA/Reg Z, ensures borrowers understand the true cost of credit through APR disclosure and standardized rules. ECOA, Reg B, prevents discrimination based on protected characteristics and requires lenders to provide specific written reasons for loan denial. RESPA, Reg X, and TRIDE created the modern disclosure system of the loan estimate and closing disclosure, stopping hidden fees and ensuring buyers know their costs before signing. Flood zone rules require lenders to enforce flood insurance on properties in designated hazard areas. The Dodd-Frank Act created the ability to repay rules and qualified mortgage standards, ensuring borrowers are not placed into loans they cannot realistically repay. Closing the loan and the real estate transaction. You learned how loan closing integrates with escrow and title operations. Lenders wire funds to escrow. Borrowers bring verified, cleared funds, such as cashier's checks or wire transfers. Escrow prepares documents, verifies instructions, disperses funds, and records both the deed transferring ownership and the loan instrument securing the lender's interest. You learned why prepaids, such as taxes and insurance, are deposited into escrow, how Alta and title insurance protect both lender and buyer, and why agents must track TRIDE timing to prevent delays. This knowledge supports your ability to guide clients smoothly through the final stages of their purchase. Commercial and business financing concepts. Chapter 17 broadened your understanding into the world of commercial loans, business credit lines, short-term loans, asset-based financing, bridge loans, blanket mortgages, equipment loans, factoring, and term loans. You saw how balloon loans, adjustable rate structures, SBA guaranteed loans, and personal guarantees shape investor and business borrowing. You learned about debt service coverage ratios, business debt ratios, basis points, and yield maintenance penalties, which are essential for larger real estate deals. These concepts prepare you to work confidently with commercial buyers and investor clients. Laws governing mortgage lending. This chapter reinforced how each law functions in practice. TILA ensures honest cost disclosure. ECOA ensures fairness. RESPA bans kickbacks, regulates ABA disclosures, and creates transparent closing documents through TRID. Flood insurance requirements protect lenders. The CFPB enforces compliance and protects consumers. For salespersons, the key takeaway is that these laws define your boundaries in advertising, referrals, and communication about financing. The mortgage market and loan programs. The chapter concluded by zooming out to the financial system that makes long-term mortgages possible. You learned how the Federal Reserve influences the supply of money through open market operations, reserve requirements, and discount rates. You explored both the primary mortgage market, where loans are originated, and the secondary mortgage market, where loans are bought, sold, pooled, and converted into mortgage-backed securities. Institutions such as Fannie Mae, Freddie Mac, and Ginnie Mae maintain liquidity, stability, and uniform underwriting standards. These entities allow lenders to keep making loans and ensure homeowners have access to long-term fixed-rate financing at competitive rates. Types of real estate loans. Finally, the chapter introduced the major loan programs your clients may use. Conventional loans, FHA insured loans, VA guaranteed loans, and USDA loans. You learned how these programs differ in eligibility, down payment requirements, mortgage insurance rules, credit guidelines, and property restrictions. This knowledge equips you to help buyers understand the pros and cons of each loan type and guide them toward lenders who can provide more detailed qualification. Closing remarks. Chapter 17 tied together the entire world of mortgage finance, from the promissory note and security instrument to underwriting, government regulation, closing procedures, the Federal Reserve, secondary market institutions, commercial lending structures, and the major residential loan programs available to consumers. When you combine this understanding with what you learned in the chapters on value and appraisal, you now see the complete financial ecosystem that makes real estate transactions possible. Financing is not just a part of the transaction. It is the engine that drives the entire modern real estate market. Mastering these concepts strengthens your ability to guide buyers, represent sellers, manage expectations, recognize risks, and maintain professionalism in every finance transaction you handle. How does the difference between a promissory note and a security instrument help protect both the lender and the borrower? Answer. The promissory note establishes the borrower's personal promise to repay, while the security instrument, mortgage, or deed of trust, pledges the property as collateral. This separation protects lenders by giving them specific rights against the property if the borrower defaults. And it protects borrowers by ensuring foreclosure must follow legal procedures rather than immediate seizure. Why is underwriting considered the most important stage of the loan process? Answer. Underwriting determines whether the borrower has the capacity, stability, creditworthiness, and financial strength to repay the loan. It evaluates income, assets, ratios, credit, reserves, and property value. A loan may appear strong on the surface, but underwriting verifies whether risk is acceptable for long-term lending. How do TILA, RESPA, and ECOA work together to protect consumers during the mortgage process? Answer. TILA ensures borrowers understand the true cost of credit through APR and timing rules. RESP ensures transparency in settlement costs, prohibits kickbacks, and requires the loan estimate and closing disclosure. ECOA prevents discrimination and requires lenders to provide written reasons for adverse decisions. Together, these laws create an environment of fairness, clarity, and accountability. Why is the secondary mortgage market essential to the stability of long-term mortgage lending? Answer. When lenders sell loans to investors like Fannie Mae, Freddie Mac, and Ginnie Mae, they recover capital that can be used to originate new loans. Without this liquidity, lenders would be limited to their own deposits, dramatically restricting loan availability and increasing costs. Why is the income approach a critical concept for commercial borrowers, even when they are purchasing a property for their own business use? Answer. Even owner users must understand how lenders evaluate the property's ability to support debt. Lenders rely on income analysis, debt service coverage ratios, and projected cash flow to determine risk. This affects loan approval, interest rates, collateral strength, and long-term financing options.